Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to this Thursday, September 12th broadcast of the AICPA Town Hall. My name is Michael Cerami and I'll be your host for today. So as we enter mid-September, lots happening. We have a lot of great relevant topics and breaking issues to discuss with you. So once again, a very full lineup for you today. We're going to kick off with a DC update from Mark Peterson, who'll be joining me live in just a second. Then we have Melanie Lauridsen. Melanie leads our tax policy and advocacy team, and Melanie's going to come in and provide a technical update. Lots to update you on there. And then we're going to close with a panel discussion on the Secure Act and some of the implications it has for retirement planning and your client advisory work. And we're going to bring in Dan Snyder, who leads financial planning team here at AICPA, and Zachary Keep, who leads compliance and risk for Paycheck. So very full agenda for you today, and excited to go ahead and get started. So let's bring in our friend Mark Peterson. Mark, welcome in.
Thank you, Michael.
Good to see you, Mark. Mark's live with us from our DC office, and it's mid-September now, Mark. We were about 60 days out from an election. Lots happening, I know, and this is all going to have implications for some of the technical updates that I know Melanie is going to jump into in just a moment. But maybe you can start by framing the presidential debate that just occurred.
Sure. You want me to get into the debate, Michael? Right. I'll tell you what, if just, it's almost impossible for anybody to ignore what's going on at the national level. So everybody's, focused on this. This is what I would say. If you're in the Harris camp, you were feeling good coming out of the announcement of her candidacy. You're feeling good coming out of the Democrat convention, and their camp feels good about her performance earlier this week at the debate. Having said that, there are some other factors in play. You mentioned, less than 60 days till the election. That is true, which can be a long time politically, right? We still have a vice president debate coming up October 1. There's discussion of a rematch between former President Trump and Vice President Harris, which could have an impact. Obviously, we know just because of what happened with President Biden that these debates do matter. But we also have early voting. So you've got 56 days left till the election, but you got people that are casting votes right now in some states, and actually in some of the swing states, we're watching very closely. It comes down to a handful of states: Nevada, Arizona, Wisconsin, Pennsylvania, Georgia, North Carolina, Michigan. And people are casting their votes already. I will also say in those, I'm sure we know the Harris camp is feeling really good about the momentum they've had. But if you actually look at the polls in those battleground states, Michael, it's still in the margin of error. It's still extremely close. And so watching how this plays out is going to be very interesting over the next month and a half. And it does have an impact. Sometimes we wish it didn't have an impact, the politics on the policy. But it does. And there are things, when we do our scenario planning, we look at potential outcomes. So if you look at kind of where we are right now based on the polls, and the polls are what they are, but they're definitely an indicator, you would call the presidential today a toss-up. But when you look again at the House and the Senate and the Senate seats in the states that are in play there, you'd give an advantage to the Republicans, states like West Virginia, states like Montana. So you could see that flip from Democrat to Republican. Same in the House, of a potential flip from Republican to Democrat. And what that does is kind of keep us in divided government. And so we've experienced that and the challenges to legislative productivity. And that's probably the most likely outcome where we sit here today. There's a possibility of a blowout on one side or the other, and long coattails from the profession, from the top of the ticket, from the presidential. But it's possible, but less likely. So, when we look at issues that we're working with right now, Melanie's going to talk about BOI, beneficial ownership information. That's a derivative of money laundering and focus on China. those issues, regardless of the outcome, are going to still be with us. Tax is going to be with us. We're going to talk about next year as a tax year. Our efforts around STEM, it's not a partisan issue. There are others that are. What that tax bill looks like, the administration's going to have a big impact. Regulation of the audit profession, public company auditing, will have a significant impact. ESG is another example. So those are all the kind of the scenarios we're working through. The only other thing that I would mention related to this is there have been challenges with congressional productivity. They're struggling to even name post offices these days because of the partisanship and the narrowness of the majority. It is just so narrow on any given day, it's hard to get much done, which is going to lead us into a lame duck. We're going to end up with a lame duck session. What does that look like will be election dependent. It will be an opportunity to get some things done, maybe some tax provisions done, maybe some other priorities, but it will really depend on the lay of the land as they go into January and who has the gavels.
That's great. That's a great update, Mark. And this is active and live, and I know you and the team are pretty well embedded in trying to make sense of it all and bringing that information back to the town hall. I know one of the big items, though, that is being kind of bandied about is the government funding update. So maybe shed a little light on that for us.
Sure. I think "makes sense" was generous, Michael, but thank you. So before we could get to lame duck, they've got to get to the government funded by the end of the month. Okay. So and this is unfortunately a discussion that we go through every year when we hit the government funding deadline about whether they're going to get it funded or not, because the appropriations bills aren't getting done during regular order. And then, are we facing a shutdown? And a couple things I would like to mention about that. There's drama around it. There was a bill that the House Republican leadership was moving forward. The votes melted down on the Republican side about moving it forward because of some of the rider policy focused on elections that was attached to it. There's a couple things, does it pass clean, or is something attached to it? What is attached to it is usually controversial historically, because, one side or the other is trying to get it done and needs a vehicle to drag it over the finish line. And then what's the length? So, there'll be a debate over a 3-month or a 6-month. That is a big deal for us, because every time we get close to one of these shutdowns, Michael, we risk the Treasury shutting down. We risk the IRS. 6 months would mean this debate could get pushed into tax season. And we've had those discussions before where we've had to tell the town halls, 1 more week and we'll know, 1 more week and we'll know. Where we are right now is they're regrouping after the bill did not move forward yesterday. The speaker pulled it from the calendar. And the most likely outcome appears to be what's considered a clean continuing resolution, which means no policy riders would go on it, and probably like a 3-month extension. So get them past the election, get them into a lame duck, and then they can deal with lame duck post-election, into mid-December. So that's kind of the way that it's playing out, but we're going to have to watch it closely. And even if they get to mid-December with a short term, they've got to figure out how long they're going to do the next one for. And will the next one be a 3-month or a 6-month or a year? All of that too frustrates policy. So each time they do one of these continuing budget resolutions, they're just kicking current funding. So they're not addressing some of the underlying issues, funding for the SEC or the IRS or things like that. So it's, right now, our anticipation is as they get it done, I don't think, which has happened in the past, the speaker is going to lose his job over it. But, we may see a little more drama before the end of this month. Likelihood is it's going to be a 3-month or into early winter.
Well, thanks, Mark. And I know probably another thing sets up more this year than some of the implications is relating to tax policy. Lots happening there. So maybe talk a little bit about that. And it's set up the conversation with Melanie in just a bit.
Sure. Melanie's going to get into some great details for you, and she's got some comparisons of the proposals that help us try and get a sense of what's coming at us. But one of the things that we watch closely, and again, it doesn't matter House or Senate, whoever's got the gavel, Republicans or Democrats, a lot of the activity that we see in both of the tax writing committees is about laying a blueprint for when there's a tax opportunity. We see the opportunity as next year, but that doesn't mean there isn't tax legislation that's moving. There was a markup or consideration in the Ways and Means Committee yesterday with 5 different bills. The likelihood that it's possible that they could move forward in a lame duck session. The likelihood is they get kicked into next year and in the discussion around a larger package. But what we will do is we'll get a sense of what it is. What's the position of, in this case, the House Republicans on the Ways and Means, although most of these bills got bipartisan votes. One was raising the threshold on 1099K from $600 to $20,000, and from one transaction to 200 transactions. So, that we get a sense of where that debate is going to go. There was also legislation, which it's hard to believe that they actually had to pass this, but would actually not allow the IRS to penalize anybody for penalties, default penalties, if they're a hostage. But that passed overwhelmingly, not a surprise. Several other workforce incentive pieces of legislation. Again, I think the story there is that we've watched these hearings and these markups, and they give us a sense of what we're going to see in 2025. Just to tee up some of the details that Melanie is going to talk you through, when we look at these big tax opportunities, it's being driven by the last big bill that expired, TCJA. So a lot of those provisions are expiring. So they're going to have to get dealt with. Okay, so that leads us to 2025. What does it look like? Okay, so that's going to be election dependent. If one side has a large majority, or they have a trifecta, they own every part of the government, they're going to be able to drive it. If it's narrower, it's going to be a different kind of conversation. And depending on the political opportunity there, do they do a big bill, or do they take a look at the expiring provisions and maybe extend the ones that are popular, or they see an opportunity from their leadership and let others expire? So there are some different options there. The other kind of macro dynamic that goes through these tax discussion is paid for. So, if they extend the provisions, how do they pay for them if they lose revenue? And so, will they be paid for? What will that pay for look like? You'll hear, increasing the corporate rate, or, increasing the individual rate are ideas, but there's always others that go with that, including partnerships. Looking at partnerships as an opportunity to raise money to implement some of these tax cuts or tax policy changes is something that we'll watch very closely. So there's the story that we see, and then there's the story we have to get ready for, because as they put it all together, we could see an impact on the profession, not only for us giving advice to clients, but actually on CPA firms as partnerships.
Mark, great job teeing that up. I mean, there's a lot there. I mean, I think we may wind up breaking some town hall attendance records next year, because there's going to be a lot of information that's going to need to be shared out with this group.
No doubt.
Well, great. That's a great job, Mark. Thank you for teeing it up for Melanie, and we'll see you in a bit in open forum.
Thanks, Michael.
All right, so let's go ahead and bring in Melanie Lauridsen. Melanie, again, leads tax policy and advocacy for AICPA. How are you, Melanie? Busy?
I'm good. We are busy. There's a lot of information to cover and a lot of questions, a lot of unknown, but Mark did a great job of teeing up the Tax Cuts and Jobs Act, which many of us know it included significant changes to the tax code. And as Mark mentioned, many of those changes, they were enacted on a temporary basis. And so they're set to expire here in 2025. So with that, let me go ahead and dive in, and let's start with the most significant expiring provisions for individuals, which are listed on this slide. For individual income tax rates, TCJA actually lowered the marginal income tax rates for many. So as an example, the top tax rate was cut from 39.6% down to 37%, and it is set to revert back to 39.6% after 2025. Also, the standard deduction TCJA increased the standard deduction, and it also eliminated the personal exemptions. So if TCJA were to be extended, the standard deduction for a married couple would roughly be $31,000, and the personal exemption would be $0. And if TCJA were to expire, the standard deduction for a married couple would be approximately $16,000, while the personal exemption would be about $5,000. Also, the state and local tax, the SALT deduction. TCJA imposed a $10,000 cap on the deductibility of state and local taxes. Now, if this provision expires, all state and local property taxes will be able to be deducted. The child tax credit. TCJA increased the tax credit for each child under 17 from $1,000 to $2,000, and in 2021, it increased it to $3,600 and back down to $1,000. But the credit the credit thresholds will also phase out. But if TCJA expires, the child tax credit will fall back to $1,000. But you have to keep in mind that the child tax credit is not indexed for inflation. And then, of course, we have the alternative minimum tax, which TCJA increased the AMT exemption amounts and raised the income levels at which the exemptions would begin to phase out. So what this ended up doing is it resulted in fewer taxpayers falling into AMT. Now, if TCJA were to expire, the AMT exemption for married filing joint couples would be about $110,000, while if TCJA were extended, it would be about $140,000. So moving on to the next slide with estates and businesses. With estates, TCJA actually doubled the state tax exemption. Now, if this provision were to expire, the exemption in 2026 would be about $14.3 million for married couples, which compared, if it were to be extended, it would be the $28.6 million. So big swing there. Also, moving on to the businesses, there was a permanent reduction of the corporate tax rate from 35% to 21%, but there were deductions for small businesses that are set to expire. So most commonly known is the Section 199 Cap A, which was the 20% deduction for qualified pass-through incomes. Now, if TCJA expires, that deduction will no longer be available. Additionally, there's a 100% bonus depreciation deduction for assets, which that began to get phased out in 2023, and it will be fully phased out by 2026 if TCJA is not extended. Then there's also R&E, research and experimentation expensing, which that expired at the end of 2021. And TCJA also significantly restricted the ability for businesses to deduct related business interest expense with the amendment of Section 163J. And that provision is set to expire in 2025. It should be noted that all of these that I'm talking about, the R&E and amortization, the restricted business interest expense, and the phase out for the bonus depreciation, all those policies are in place to offset the overall cost of the corporate provisions. So on this next slide, I have some TCJA considerations. Now, TCJA permanence would increase the after-tax incomes across all the income groups. Now, there are various estimates of what it costs in keeping TCJA permanent, with the most conservative estimate being about $3 trillion over 10 years, so through 2034, and many estimates coming in around $4 trillion. So in other words, if TCJA expires, taxpayers would see an average of 2.3% in increased taxes. So with those in the lower tax brackets, they would be seeing the smaller increase, while those in the higher tax brackets would be seeing the higher increase. So of course, this has led to a lot of speculation as to what's going to happen. And no matter what happens, whoever is in office, after 2020, well, coming up here in the next year, lawmakers will have to take a look at TCJA expiring provisions because it will set the landscape as to how Americans gets taxed. So let's take a look at what former President Trump and Vice President Harris have proposed. And on this slide, let me start off by saying it absolutely needs to be noted that both presidential candidates have talked about tax policy proposals, but there are no specifics that have been released. And of course, we all know that the devil is in the details. Now, it should also be noted that the information in this chart can change wildly at any given moment in time between now and the election. Also, I've only captured the main policies the presidential candidates have made statements about, so we won't be seeing things like the SALT cap deduction because they haven't stated or given an opinion on it. So it isn't to say that they won't have a policy on it, it's just to say that right now we don't know. So with individual, we already covered the current tax rates under TCJA, and Harris has proposed increasing that top rate back to 39.6%. But she's been very adamant about saying and promising that households with income under $400,000 will not see a tax increase. On the other hand, Trump has proposed to make TCJA permanent, keeping the tax rates where they're currently at. Moving on to capital gains rates, the current top tax rate is 20%, and the net investment income tax is 3.5%, which is for the wealthy. Now, Harris has plans to increase that top tax rate to 28% and increase the net to 5%. And she's also endorsed a proposal to tax unrealized gains for the super wealthy. So that's a big change for us. And on the other hand, Trump, he does not have a current proposal. Now, taxation on tips is an interesting proposal since this is one of the very few proposals, if not the only policy, where both candidates seem to agree, and both candidates support eliminating tax on tips. So, child tax credit. Harris echoed her position during the debate that she wanted to increase the child tax credit to $6,000, and it is our understanding that she has proposed this increase for those with infants under 1 year old, and she's proposed a $3,600 credit for all others. Moving on to the next slide, we already covered the current estate tax under TCJA, and we know that Trump wants to make TCJA permanent while we don't know what Harris is thinking about on that issue. I also had mentioned the corporate tax rate was being lowered permanently to 21%, while Harris has endorsed President Biden's proposal to increase that corporate tax rate to 28%, while Trump has suggested on occasion either 15 or a 20% tax rate. Also in September, Harris announced a slew of proposals to benefit small business formations, which does include a startup deduction of up to $50,000 in comparison to the current $5,000. And she's also had a few other provisions because she does want to see businesses grow. Now, there is nothing specific from Trump, but it wouldn't surprise me if he did provide something for small businesses eventually. Also on this slide, you can see that Trump proposed to extend the TCJA provisions for international taxation. So what all this means, and on this next slide, I have some resources, is everything that I've covered with TCJA is complicated and difficult to cover in a very few minutes because there's a lot of details behind it. But we actually have a great landing page with lots of different articles, webcasts, videos, podcasts. And I also know that this page will have more information soon. So I really encourage people to reference this resource page because we will be continually updating it as the information progresses and we learn more from the candidates. So with that, it moves us on to beneficial ownership of information. So as many of you know, as of July, only 2.5 million people have filed their BOI reports of the expected 32.6 million. Now, because of this, FinCEN has started to really focus on raising awareness, and they've also been talking extensively with us to understand any hesitations that entities may have on filing. Now, as part of their efforts, FinCEN has recently reached out to most of the CPA state societies to hear what they have to say and to get a better understanding of people's pain points. So this is really great to see FinCEN heeding our advice and making the effort to understand business entities. We've also helped them connect with the insurance industry so that they can understand that perspective too. So what we've learned from our members is that there are three main pain points as to why people are hesitant to file. Now, and they're listed here, UPL and liability, lack of clarity, and the 30-day timeframe to update or correct BOI reports. And I'm not going to go into detail since most of you have already heard the specifics. And more importantly, hopefully, we hope to see some resolution on these main concerns soon. And in November, FinCEN will be joining our town hall to provide us their latest updates. So please stay tuned as that moves forward. And on this next slide, we've got great news from Iowa. This week, Iowa's Supreme Court actually made an order to amend their court rules. And they specifically said that their new rule would clarify that it is not unauthorized practice of law for non-attorneys to assist clients in preparing, filing, and determining whether to file the BOI reports. Now, this is the most straightforward ruling that we've seen, and it's very crystal clear that CPAs can provide BOI services for entities in Iowa, and there is no UPL. Now, we hope this ruling will actually set a precedence for the other states because from our perspective, it is extremely confusing if each jurisdiction were to have their own opinion. And it's because of this confusion that we continue to keep working with FinCEN and other stakeholders to find a simple, manageable solution. And as always, the link on the slide is to our BOI Resource Center, which has background information and a lot of other client-facing resources that you can use. So, now, on to Employee Retention Credit, ERC. You may recall that during the summer, the IRS had announced that they were going to move forward with processing ERC claims, and specifically, they were dividing the claims into 3 categories: low risk, medium risk, high risk. And the idea behind these categories was for them to be able to pay the low risk claims quicker and to be able to start processing those high risk claims faster. So as a result, the IRS identified 50,000 valid ERC claims to send payments to, and they also sent 28,000 disallowance letters to businesses that were in the high risk category. Now, some of our members already gave us feedback that some of those denial letters were incorrect. And then earlier this week, Commissioner Warfel actually acknowledged that approximately 10% of the denial letters were incorrect. Now, from conversations that I've had with the IRS, I know that they are interested in learning from those incorrect letters because the IRS actually has filters and algorithm to be able to identify these high-risk claims. So as they get feedback from you on these incorrect claims, the IRS will start to make adjustment to those filters. And what that means is that the next batch of denial letters will be more accurate and there will be less incorrect. And Commissioner Warfel actually said that he believes that the error rate will be lower than 10% for future waves of denial letters. So for more information, we have our ERC resources center link here. And I've also linked to a blog from Erin Collins that provides a great recap on the ERC. And she talks about how the IRS actually deviated on the process of the denial letters. So with that, let's move on to data security and fraud prevention. So we've been talking a lot about scams that are targeting tax professionals in the hopes of gaining valuable, client tax information. And the IRS actually just came out and said that they've had nearly 200 reports of tax professional data breaches, which impacts a large number of taxpayers out there. So the IRS recently released an updated written information security plan called the WISP to enhance protection against identity theft and data breaches. Then the AICPA also has a resource library that provides additional guidance to provide assistance with proper compliance with the WISP and also with FTC safeguards. Also, there's a link there for an identity protection personal identity number. That's the IP PIN. You should know that you can get an IP PIN even if you're not a victim of identity theft, but if you want to take those extra precautions. And then, of course, there's an email address that should you suspect scams or identity theft, you can reach out in that way. Now, with disaster relief, we are in hurricane season, and most recently, IRS provided disaster relief to our nest of victims and also to victims of the severe storms and flooding in Connecticut and New York. Now, for both relief efforts, taxpayers now have through February 3rd to file various federal, individual, and business tax returns and payments. Now, we're also keeping an eye on relief for the wildfires in California and Nevada, and also Tropical Storm Francine along the Gulf Coast and Louisiana. In California, we know that some schools have already been canceled. And also we know that RSM was evacuated out of Orange County 2 days ago. So our efforts in this area are to try to get relief granted earlier than having to wait until there's a presidential or a FEMA declaration of disaster relief before disaster relief can be extended. So, of course, for more information, we have our disaster relief landing page. And also there's another blog there by Aaron Collins with a little known issue about the look back trap and refund claims and how that works and how to avoid that trap. So finally, we're also going to talk about the audits of high net worth individuals. On Friday, the IRS announced that they recovered $1.3 billion from high-income, high-wealthy individuals under the Inflation Reduction Act initiatives. So again, these are great initiatives for the IRS. However, TCJA actually released a report at the end of August saying that the IRS has made limited progress to not increase the audit rate for taxpayers with incomes below $400,000. So this is something that we're going to keep an eye on as these audits move forward. And before I wrap up, I want to add something that is not on any of my slides. The corporate AMT proposed regulations package was just issued today, and it's also very heavy on partnership information. It's about 600 pages long, and they've given 90 days for a comment period, but we're already looking at it and looking to see how to best respond to that. So with that, I wrap it up.
Melanie, that was fantastic. Very comprehensive. Nothing brings out the Q&A like the technical update portion of the town hall. I think we might have broke the laptop there for a second. But there is one question I wanted to feed you. We'll obviously have you back in open forum, but just clarify for folks because a few had asked, when does the first set of TCJA actually expire? Is it December of 25? Is it January of 26?
So it expires in 2025. So it should go through, I'm trying to think, well, it depends. Keep in mind, some provisions have already expired and there's phase outs and whatnot. So it should go through 2025. Great.
Well, great. Thank you, Melanie. We look forward to having you back in just a bit, but great update. Appreciate it. So we're gonna pivot here and talk a little bit about the Secure Act and some pretty big implications for retirement planning. And I think we can go ahead and bring in our two subject matter experts, Dan Snyder and Zachary. Welcome. So Dan and Zachary, maybe before we bring you in here, I could just set this up a little bit for you and for our discussion. Really, the goal here is to talk a little bit about the Secure Act and the impact it's going to have on retirement planning. But kind of as a precursor to that, we've had a savings crisis in this country for a fair amount of time, and I think that's only been exacerbated, as you can see on this slide, by a lot of different activities in the marketplace that are just making things even worse. And so kind of in this context, there's a big outcry to try and encourage and promote just more responsible saving. So Dan, I want to kind of invite you in to talk a little bit about this and maybe help us frame this discussion before we dig down into some of the details of this with Zachary.
Sure. Well, thank you, Michael. Go back to the previous slide for just a moment. I think it's really important to kind of realize that these topics that you see on the screen, I mean, we all know they're urgent issues with many Americans. And what happens when it comes to retirement is many times so far in advance that it's important, but it's not really that urgent. And so that kind of sways, that's part of the mindset that people have. But what I would observe on some of these topics is these topics and many more are things that CPAs are already talking to clients about, because tax touches many of these topics. So as we think about retirement and go through this, just realize it's an opportunity to tie these retirement questions to their broader personal finance situation. And it really opens up opportunities for those personal financial planning discussions with the client, which is that broader relationship there. So the real value of the CPA and the advisor coming into this type of a conversation is to help the client to balance what's important with what's urgent. and kind of make that, basically just focus on what is really important there.
It's a great point, Dan, and probably no can gets kicked down the road more than thinking about retirement savings. So.
Yeah, and this one here, Zach, why don't you jump in? You're going to talk a little bit about what the government's done in light of that crisis.
Yeah, I think as we move through the balance of our time today, it's important to think about what you just discussed, Dan, and that is, the retirement crisis and the ways that retirement crisis sort of intersects with some of the things that we see on this list here right now. I think as we talk about Secure 1.0 and talk about Secure 2.0, which we're going to do in detail in just a moment, I think these two massive sweeping pieces of legislation are really the attempt on the part of Uncle Sam to see how much can employer-sponsored plans help with retirement and also with some of these other items as well. So I would encourage you to view everything that we talk about through the lens of the retirement crisis, the emergency fund crisis, maybe let's call it the everything crisis. I don't know.
Yeah, I think just like in the tax area, as new things come out, it's really crucial for our profession to be ahead of the curve when it comes to this, so that we can be looking at that. I think the next slide, what we want to do is just kind of set the stage here. We're going to be talking about the Secure Act. We're going to be focusing on the aspects that relate to retirement plans. In a future town hall, we can talk in more detail about the personal and individual side of things, but you see the topics on the screen here, and we're going to go through those. We're going to talk about, how they apply to how they impact clients, and also what kind of opportunities come out of that.
Yeah, so let's drill down into each one of these a little bit more. So Zach, maybe you can take us through the startup tax credits.
Yeah, absolutely. So if we move to the next slide, we're going to kind of kick off with one of the most exciting parts of the Secure Act. Secure 1.0 came along way back in 2019. And what Secure 1.0 did was introduce a number of startup credits. What these were designed to do were to incentivize employers to establish a plan, whether that be a 401k plan, maybe a 403b plan, depending on the employer. And initially, with Secure 1.0, the goal was to, kind of offset some of the plan establishment costs. And initially, things were kind of slated to offset 50% of those startup costs. But then Secure 2 came along. And could we possibly advance to the next slide so we can take a look at that? Wonderful. What Secure 2 did was increase those startup tax credits. It also added an employer contribution tax credit. And I think for this audience, for the folks who are watching this, your clients, especially the ones who are contemplating the establishment of a plan, they're going to want to take advantage of these. So I want to go through each of those tax credit pieces in detail before we move on to some of the other aspects of Secure 2.0. So let's talk startup tax credits right now. These tax credits are designed to help the small and medium-sized businesses. So if we could, I'm sorry, possibly we could just move to that previous slide so the audience can take a look at the startup credits. What these really do is encourage the employer to establish the plan by offsetting for the smaller businesses all of their startup costs. Initially with Secure 1.0, that was 50%. Now it moves up to 100% of eligible startup costs for any employer with 50 or fewer employees. And that is capped. It's not an unlimited tax credit, nor unfortunately is it a refundable tax credit. It's going to be capped at the $5,000. And For employers that are a little bit larger, maybe not quite in the small business space, more in the medium-sized business space, the Secure 1.0 paradigm still remains in place. And I think that's an important thing to note. For those smallest employers, the ones who historically maybe never engaged with the retirement marketplace at all, maybe they would look to estate plan, something we're going to talk about more in a bit. Now, those employers are going to have the option of establishing probably a 401k and doing so in a way that really doesn't impact the bottom line if they're the very smallest employers. The larger employers, above 50 employees, they still reap the benefits of Secure 1.0. So we kind of knew in the waning days of 23 when we were wondering, will Secure 2 pass? Will Secure 2 not pass? I think myself and my team were reading through Secure 2.0 as the Christmas music was playing. We expected to see startup tax credits, but the government went a little bit farther. And let's take a look at what they did in the next slide, because this kind of came as a surprise to many folks in the industry. Not only were there startup tax credits, there was also an employer contribution credit. And I don't know that anyone was really expecting this to happen. And what we see here is an attempt not just to incentivize plan establishment through a startup credit or the expansion of a startup credit, but the intent to encourage employers to offer a rich plan, a fully featured plan, to allow for the employer match that we all know and love. Once again, targeted at some of the smaller employers out there, that same 50 employee. And what this is really doing is introducing sort of a phased offset of employer contributions. It's not permanent. It's kind of phased out with larger employers. It phases out as an employer grows. If we could maybe just advance one more slide and take a look at that, that would be awesome. This, again, the intent is not just the bare bones plan, but a plan that really enables employees to contribute and also to realize the additional benefits of an employer contribution.
So, Jack, let me jump in for just a minute. So on the first couple of items there with the employer, then with this type of legislation, it takes away a lot of the early hurdles of saying, should I start something? Should I not start something? And so this is an opportunity for them to start that process. And many times a retirement plan can be something that differentiates them in the marketplace. So
exactly
so
right.
That's where I'm looking at the employer side of things. But then if you go to the auto enrollment, then they're equally providing some incentives for the employees. And that's what we're looking at in both of these, is that for something that's important for the future, but not really urgent now, there's a lot of inertia that says, I'll just deal with that later. And so these types of things are the perfect conversation starters to be able to say, look, the government is going out of its way here to be able to kind of move it forward and to try to say, hey, you need to get this started. And one of the things that I would observe with auto enrollment is that it's going from an opt-in opportunity to an opt-out opportunity. And so that's going to get more people coming into it. But the net result of that is the pain that many times when it comes to enrollment is in that first paycheck, right? That's the piece. And so if you can get past, if we can help our people get past that first hurdle, then we're in a great situation to be able to say now they're going to start to grow exponentially over time.
I think you're exactly right with that, Dan. So often, the folks in our audience today, probably more so than myself at Paychex, you have probably heard from your clients, the employee who will decide, next payroll, that's when I'll enroll in the 401k. And now, or at least starting in the new year, that's no longer going to be the case for newly established plans. Auto enrollment is if you were to force me to point at Secure 2.0 and say, what is going to have the biggest impact? Auto enrollment will, 10 years from now, hopefully when we are all here having this webinar again, auto enrollment is what's going to change the face of retirement, because it's now something you need to opt out of. And that's not for every employer out there. There's a couple of quirks to be aware of. Some of the newly established employers, this doesn't happen immediately. Some of the very, very smallest employers, those with 10 or fewer employees, auto enroll won't be so much for them. But it's also important to remember, and I think you kind of touched on this a little, Dan, that an employer can choose to do this. Just because they don't need to have automatic enrollment doesn't mean that they can't have automatic enrollment. So my hope is that this provision with Secure is going to really encourage employers to think about, hey, how can we minimize that pain? How can we minimize sort of almost that paralysis of when will I start this? Well, now the question is, when will I notice this? When will I notice that I'm contributing? And with auto escalation, I think this is over time going to make an absolutely tremendous difference for many, many employees.
Yeah, and we've already seen that. And if you compare before Secure and after Secure, we've already seen the number of plans have gone up, the number of people with access has gone up, the number of accounts has gone up. But the next slide kind of goes on to the, a popular topic a while back. It doesn't get quite as much play now. Let's just hit it just real quick and talk about student loans.
Hey, Dan or Zach, before maybe we jump to this slide on the student loan stuff, one question that's been asked a lot, but you tell me if you want to punt it to open forum, is just, does this have a greater impact? Does this impact existing plans in addition to new? Is it just one versus the other? Or is it, again, if you'd rather tackle that in open forum, but let me know.
Yeah, this is really going to be for the newer plans out there, Michael.
Okay.
That said, it doesn't need to be. Again, I would go so far as to say any employer might be well served by considering automatic enrollment. It's an option. It's been around for a while. The advent of Secure kind of makes it a mandate for certain employers, but again, it can be a good option for everybody.
Great.
So to your point, Dan, why don't we kind of shift gears and talk about student loan payment? You alluded to this, and I agree with you. I think out of everything in Secure 2.0, automatic enrollment is the one that will change the face of the retirement industry, but student loan payment matching was the thing that everyone wanted to talk about. I think more ink has been spilled on this than any other provision in either Secure 1.0 or Secure 2.0. And I can see why. We all know there's a student loan crisis. We know there's a retirement crisis. This puts the two together. So starting next year, we will have, starting 24, we will have the option to do this. Student loan repayment has been around. We very recently got some long-awaited guidance as to how is the employer going to police this? How do they make sure that the employee actually has a student loan before they provide them with a student loan match?
Yeah.
And without going into the details, I think a lot of this is going to be left for the employer. In other words, the IRS is kind of leaving this up to employers to police as aggressively, or maybe not as aggressively as they want. That said, Dan, you mentioned this. I think the industry is kind of taking a little bit of a wait and see with respect to this provision.
Right, and I think the bottom line, as far as what does this mean out there, if you have clients that are hiring younger people with a lot of loans, this may be a distinguishing feature between their going to their company versus somebody else. If you're in an industry that's hiring more seasoned people and they're not right out of college, maybe don't have loans, it's going to be less of an issue there. So just want to make sure that you all are aware of that and what's out there. The next point here, I think, is a really good one, because with part-time people, being able to expand that access to part-time people, these people never had access to retirement plans. These are people that maybe have multiple part-time jobs. And so I think, just quickly here, so we can move on, but I mean, just got an opportunity for them as well.
Yeah, without a doubt. The name of the game with Secure is expanding access for everyone. And part-time employees are definitely included in that, lowering the threshold to eligibility to 500 hours worked, allowing that 500 hours to be in consecutive years. Once again, that same theme. How do we make it easy? How do we make it automatic? How do we make it simple, both for employers and also for employees of all stripes, full-time, part-time, new, seasoned? Now, also important to note, if I may, just a couple of administrative changes. I think our folks in the audience will probably want to at least note that there have been some changes to the RMD paradigm with Secure 2.0. There have been, without getting too far into it, there's changes in the age at which RMDs commence, and also some quirks to be aware of with beneficiaries. I think in the time we have remaining, we're probably running a little bit short to delve into that, but definitely something to look closely at, because RMDs affect us all sooner or later.
I think the one point in this slide, just to make everybody aware of, is that with the Secure 2.0 final regs that came out in July, the RMDs for 401k and 403b plans are no longer mandated, so it puts them on a par with IRA accounts. So with the Roth IRA, so the Roth 401k, Roth 403b, they're no longer mandated like they were previous to that. So I think we got. Let me just hit one thing on the next slide, and then we can wrap up with the opportunities. The thing here is we've got multiple employer, pooled employer, and traditional plans. Just highlighting here that the new thing here is that pooled employer plans are very much like multiple employer plans, but they have the opportunity for unrelated companies to be going, to be included in that. So the piece that I think it's important to leave you all with is the fact that, how does that compare in general to traditional 401k? And the answer there is, if you want to customize something for the owner or for the key employees, you're going to want the 401k to give that flexibility and control. But if you want to focus on something that's low cost and benefiting as many people as possible, then certainly the pooled employer plan is a real option there.
Well, so yeah, I think that sums it up perfectly. With a pooled employer plan, the employer sheds a lot of the fiduciary liability and a lot of the day-to-day burden of running that plan as well. Good fit for some of the smaller employers out there.
And we have some great resources. The next slide just kind of detail. Oh, let me jump in. Zach, why don't you cover this real quick here? The state retirement.
Yes. So, important to be aware that at this point, the spread of state plans is accelerating. Many states already have a mandate that employers sometimes of a certain size offer a retirement plan. Sometimes that's done through a state IRA. I would encourage everyone on the line, everyone who can hear my voice right now, take a look at some of the resources that we provide, kind of free for all. See what the situation is in your particular state. There's a good bet that you are already subject to a state mandate, or that your state is contemplating a mandate. If that's the case, know that whether it's a state IRA or something different, there's always the option to go to an employer-sponsored plan that is going to satisfy the state mandate as well, and maybe offer some additional bells and whistles, something to keep in mind.
So guys, that was great. Very comprehensive. There's probably need a lot more on this topic than what we're able to allot. But to Dan's point, there are a lot of resources available. Paychecks puts out a wealth of resources. AICPA has a ton of resources, as does CPA.com. Dan, maybe just elaborate a little bit in the personal financial planning section. There's a planning toolkit, and there's some locked content in there, unlocked. And then I think the big thing is we have an upcoming webinar that just goes very deep onto this topic, but maybe give you last word on that.
Yeah, so in the resource section for the PFP section, the proactive planning toolkit is open. And then within that, there's both locked and unlocked content. We've had a number of in-depth webcasts in the past that are available there. We've had some podcasts and a variety of things. So I would encourage you to take a look at that. And then certainly the AICPA's 401k plan under the firm member benefit program is another thing to take a look at from a resource standpoint.
That's right. There's two sides of this. There's the client side, but then what are firms doing themselves for their own employees? So great point. Well, thank you guys. So let's go ahead and bring in all of our speakers today. We'll do a quick round robin open forum. Welcome back, Melanie, Mark. Good to see you. So a lot of questions. So I'll just throw a few quick ones out. Mark, maybe we'll start with you, and maybe sure. Melanie wants to weigh in too. But a lot of questions just on it's probably two-part. How we identify those items around tax policy we pick a position on, and we maybe advocate one way or the other. And then there was some a fair amount of questions just on, do we have a position on this whole tax on unrealized gains concept? So I'll throw that over the fence to you.
Sure. Well, I'll kick off, Melanie, and I could turn it over to you because you're responsible for the tax executive committee. But in general, we focus on administrability. We don't weigh in at where the bracket should be. We really focus on administrability. I will say that if it's again something that impacts partnerships, specifically, accounting firms, we definitely will weigh in. And the third bucket is we may not take a position, but we always want to be a resource for policymakers. We want the best outcome, the best administrability that we can get to our preparers, and also that I would include the IRS in that conversation, because they're ultimately going to have to implement it. But let me turn it over to you, Melanie, for some comments too on that.
I think you gave a good overview of how we come to positions in policy, and it should be added that we work extensively with our members and the volunteers that we have. And so our members are the boots on the ground, and they tell us when things are working, when things aren't working, and we learn from them what those pain points are. And then, as Mark was saying, we have what's called the guiding principles of good tax policy. It needs to be fair, simple, equitable, transparency. There's all sorts of things that go into it. And that's how we approach what we will advocate on, and some things just, it won't make that much of a huge difference for our practice and our members and our people. And so we wouldn't necessarily look at it, but we would monitor it.
Great. And maybe just staying on tax real quick, again, Mark, Melanie, just maybe 30 seconds on SALT and how the specific impact it could have on the swing states as far as changing policy.
Well, so when if you look at the swing states, they're not impacted by SALT. When you think of if you think about how that all came about, it really is, for a Republican administration, it's blue states. The swing states are Arizona and Nevada and Wisconsin and Michigan and Pennsylvania. Having said that, there are Republican congressional districts. It does hit politics, I'm sorry, in states that had high state tax, and so there was an impact on them. And so there is a contingent of Republicans that are pushing for a SALT fix, but it does get caught up in politics.
Great, thanks, Mark. And maybe final question, and Dan, maybe this is for you or Zachary, but does the Safe Harbor plan remove the need for additional testing around student loan payments?
That's a great question. Student loan payments are really not, in short, in our waning minutes together, student loan payments are really not going to shake things up with respect to testing. They can be tested separately.
Great. So great answer, Zachary. Thank you. I want to thank our subject matter experts. Great job, everyone. A lot of content you covered in a short amount of time. So real quick, I just want to remind the town hall audience that if you miss a particular broadcast, we do have an on-demand feature, and you can view it through your favorite podcast platform. So we're really excited to continue to evolve this feature for the town hall audience, and maybe more importantly for some of you, it will offer CPE and live Q&A, so you can do the rebroadcast and qualify for CPE, which is really a great addition. The team has worked really hard on getting that done. Want to remind everyone, September 26th is our next AICPA Town Hall. Eric will be back in this seat, and he's going to have a full studio audience with him, Lisa Simpson, Dan Hood, Andrew Argue, and Rachel Dreesen, so you're going to want to tune in. With that, we know all of you are, or many of you are entering a very busy or in the middle of a very busy filing extension season, so wish you well. I know you're all very busy, and hopefully today's session helped to answer some questions for you. So thank you, and I hope everybody has a great rest of the day.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.